Welcome to the Explainer. I'm absolutely thrilled you're here today because we're doing something incredibly exciting. We are taking a single stock, Universal Insurance Holdings, ticker UVE, and we're running it through the ultimate test. We call it the Guru Gauntlet. We're going to act as expert investment analysts and filter this company's latest data through the legendary frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and some strict discounted cash flow modeling. By the end of this, we'll know exactly what this stock is truly worth. Let's get into it.
All right, here's our roadmap for today. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. DCF and alternative models. And finally, 6. Final synthesis and verdict.
Starting with Section 1, Company Snapshot. Universal Insurance Holdings, ticker UVE. So just to set the stage, UVE is a $1.16 billion property and casualty insurer. They're heavily concentrated in Florida, but they're actively expanding across 19 states. In tracing their recent momentum, UVE has been on an absolute tear. They've delivered consecutive earnings beats quarter after quarter. In Q1 2026 alone, they jumped from $1.44 a year ago to a massive $2 adjusted earnings per share. And this wasn't just a lucky earnings win. Their direct premiums written actually rose 8.5% to over $506 million. This is a business with undeniable forward momentum right now.
Moving on to Section 2, the Buffett lens, moats, management, and margins. Now, the Oracle of Omaha demands a strong economic moat and shareholder-friendly capital allocation. UVE actually demonstrates this through localized Florida expertise and aggressive share repurchases. And Buffett demands disciplined management, right? Well, listen to what CEO Stephen Donaghy explicitly stated. He said they are, quote, chasing rate adequacy more than chasing business. This means they aren't just growing for the sake of growth. They're prioritizing profitable, properly priced underwriting. In fact, their net combined ratio improved to 89.7% this quarter, proving they're really walking the walk.
And then there's this phenomenal number, 38.5%. That's UVE's annualized adjusted return on average common equity. We all know Buffett loves a high ROE, and honestly, anything over 15% usually turns his head. So 38.5%, that is completely off the charts. Pair that with their highly manageable debt. They have just $100.29 million in debt compared to a massive war chest of $595.7 million in cash and cash equivalents. That kind of fortress balance sheet is a massive checkmark for the Buffett framework.
So what's the ultimate Buffett verdict here? Well, if we use an annualized net income of roughly $217 million as a proxy for his preferred owner earnings metric, UV easily meets his criteria for intrinsic value. Factoring in his classic 30% margin of safety, UV acts as a strong buy at the current $37.44 price. In fact, Buffett would likely establish his buy threshold right around $40 a share.
Up next, Section 3, the Lynch lens, finding the cyclical stalwart. UV fits Peter Lynch's cyclical stalwart category pretty perfectly. It balances those inherent hurricane risks with a steady 40% year-over-year book value growth. But what's truly compelling is this incredibly low 0.16 PEG ratio. You might remember Peter Lynch popularized the PEG ratio, which takes the price to earnings multiple and divides it by the earnings growth rate. Generally, anything under 1.0 is considered a great value. Well, UV trades at a remarkably low 6.1 times earnings. When you divide that 6.1 PE by the recent 38% EPS growth rate, you get 0.16. That is practically screaming undervalued in Lynch's playbook.
Because of this, the Lynch verdict is highly favorable. Between the remarkably low PEG ratio, a massive $1.53 billion in invested assets bolstering their strong balance sheet, and active insider buying via corporate share repurchases, which always signals management confidence, this is a clear Lynch-style strong buy. For a cyclical stalwart with these metrics, Lynch would easily be a buyer anywhere under $45 a share.
Section 4, the Graham lens, the defensive investor. Let's see if UVE offers the fundamental safety, tangible assets, and wide margin of safety required by the classic defensive investor. Walking through Benjamin Graham's strict checklist, UVE actually passes every single metric with flying colors. Adequate size? Yep, $1.16 billion market cap. Strong financials? Cash vastly outweighs debt. Earning stability? Highly profitable. Dividend record? Yes, paying a continuous $0.16 quarterly dividend. But the real kicker here is the moderate multiples. Graham mandates that the PE ratio multiplied by the price-to-book ratio shouldn't exceed 22.5. UVE has a 6.1 PE and a 1.78 price to book. Multiply those and you get a combined score of just 10.85. That's less than half of Graham's maximum threshold. And here is where it gets really mathematical. But stay with me. Using Graham's classic intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, we find a calculated intrinsic value of $53.31. Because the stock is sitting at $37.44 today, this offers the defensive investor a near 30% margin of safety. Benjamin Graham would absolutely touch this stock at current prices.
Moving into Section 5, DCF and Alternative Models, Projecting Future Cash Flows.
Stepping into the purely quantitative phase, we built a highly conservative discounted cash flow base case using a standard 10% weighted average cost of capital. When we stress test the valuation, the resilience becomes incredibly clear. Our base case gives us a fair value of $61 per share. But even if we heavily penalize the company with a much stricter 12% discount rate, just to account for the risk of operating in Florida's hurricane market, the fair value still sits comfortably up at $52 per share. The math is just incredibly supportive of the current stock price.
And we aren't just relying on DCF here. When applying other alternative models directly from our sources, the undervaluation persists. Simply Wallstein's excess returns model, which looks at how the company converts equity into returns above the cost of capital based on their historical 18.29% ROE, points to a $44 fair value. Meanwhile, a conservative comparable PE multiple model, assigning them a fair 8.1x multiple instead of the industry average 12.4x, suggests a fair value of $48.84. Literally every model points up.
Which brings us to Section 6, Final Synthesis and Verdict, tying it all together. We've run the qualitative frameworks and the hard numbers. Now let's synthesize it. The ultimate payoff of our analysis shows a glaringly clear consensus. Every single valuation model, from the ultra-conservative excess returns model at $44 to the DCF base case at $61, prices UVE significantly higher than its current $37 trading price. The market is clearly applying a massive discount to this stock relative to its fundamental earnings power. However, as expert analysts, we have to neutrally weigh these incredible strengths against the inherent risks, right? Looking at the positives, we have a towering 38.5% return on capital, a dirt cheap 6.1x PE, and crucially, management just secured an additional $352 million of multi-year reinsurance coverage, taking them safely through the 2028 treaty period. On the flip side, the risks are very real. Rising out-of-state expansion expenses, and of course, the ever-present, totally unpredictable threat of Florida catastrophe hurricane seasons. So all the models, the legendary gurus, the complex spreadsheets, they are literally screaming buy at current prices. The fundamental business is executing flawlessly. But the final thought I want to leave you with is this. Investing is fundamentally about pricing risk. Is this mathematical margin of safety wide enough to protect your capital when the next literal storm makes landfall? That is the ultimate question you have to answer before adding UVO to your portfolio. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.